second webinar in our series this year. It's called Financial Considerations for Your Farm Succession Planning. And I'm really delighted to have Jon Jaffe with us from Farm Credit East and Mike Ghia from Land for Good, our Vermont field agent. And Jon will be doing a lot of the presenting today, but they'll both be with us to answer lots of questions. If you missed our first webinar, it is recorded, and if you did not get an email for some reason about getting that recording, you can reach out to me and we'll get you the recording. We will also be making available a lot of the resources that we talked about last week, as well as anything that comes up today. We'll send out a follow-up email later this week, giving you all that information and a link to the recording. As you know, we're using Zoom today. So if you have any questions, you can reach out to me using the chat box. You can write a message to all of the presenters and everybody in attendance using the chat box and clicking to everyone, or you can send something directly to me by finding my name, Shemariah, in the list and send me a message if you need help. We are recording today, so keep that in mind. We have everybody's audio and that you are muted at the moment. You can turn that on and join the conversation if you have questions or things that you want to do to share. That's welcome. And we'll be taking questions in the chat box for now, and then we will have a Q&A period at the end, and we'll pause throughout the presentation to answer timely questions that help clarify, and then we'll have a lot of time at the end for more discussion and Q&A. So we are going to get started. I think that's all of my logistics, and I will pass it over to Mike to introduce himself.
Hi, I'm Mike Ghia. I'm the Vermont field agent for Land for Good. I work on all of the aspects Land for Good works on in terms of farmland access and tenure and farm transfers. And that includes working through the Vermont Farm Viability Program, where I get to work intensively with farmers over the course of a 2-year period, and often very much longer, on farm transfer and succession. Some of the farmers I've been working with for almost a decade, since it can be a long process. I also do this work for farm viability through the University of Vermont Extension Farm Viability Program. And in my work with Extension Farm Viability, I also do work with farmers on business plans and financial analysis. I also work for the Vermont Agricultural Mediation Program. And then I'm a maple sugar maker, so I am very busy today. Jon,
Okay.
go ahead.
Very good. Thanks, Mike. And I'm Jon Jaffe. I'm a farm business consultant, estate planner, and tax specialist with Farm Credit East, where I've been for 37 years now. I was a dairy farmer in my first life, but I've been with Farm Credit for that 37-year period. During that time, I have done over 300 estate plans. I've probably worked with over 1,000 farmers over the years. There aren't too many things that I haven't seen or done. I was also a loan officer for the first 15 years with Farm Credit. So I've worked with a lot of farmers on their financial viability and on their future. And that's kind of what we're going to focus on today is the senior generation's getting to the stage where it's time for a change. And are they ready to do so, or are they not ready to do so? I'm going to talk about the financial end of it. I'm going to have 4 case studies that we're going to use towards the end of my presentation to kind of illustrate what we've got going on. And then we're going to have some Q&A with a little bit of Q&A in between. You have that first slide up, Shemariah? Shema?
There you go, Jon.
Okay. I'm seeing the 2020 Gartner Magic Quadrant for Meeting Solutions. So that's,
Yeah, I'm not seeing the slide up.
Uh-oh.
not being fussy.
Happened?
Yeah.
There. Are we back in business?
Well, we're on the retirement one. I'm not sure that's where John wanted to start.
I'm still on the Gartner leader. Let's try this. Meeting. Okay, there we go. All right, we're back with. So let's go back to the first slide.
This one?
All right. As I said, I've done this for 20 years actively doing estate planning, farm succession, and almost 40 years in total. When I talk to people, this is the typical order. They ask about the taxes, the viability, and the retirement. They're most concerned about the taxes. If I retire and I sell the farm or transfer it, what's the tax liability going to be to me? That's the farmer's number one question. Number two is, the farm's doing okay, but I'm not sure it can afford to have both first and second generation. And the third question they ask is their retirement, because they just don't want to deal with it. In almost all the farm estate planning that I do, I turn that around exactly. The very first question is retirement, because what's most important is the senior generation. They've owned the farm, they've worked the farm, they've worked hard, and now they're generally getting towards retirement age, and the farm will be their source of retirement one way or another. And we're going to talk a little bit further about how much do they need the farm for their ultimate retirement. But first question I always ask is, when are you ready for retirement? What are you going to need financially for retirement? Again, we'll talk about that. And how much do you have of your own resources, and how much is going to need to come from out of the farm? So retirement is number one. Number two is viability, and that's an important question. The farm obviously made enough money in general to keep the senior generation going. Is there going to be enough money to have funding for the next generation and potentially to pay for the senior generation's retirement? So we look at that next. And taxes, frankly, is kind of the end of the road. Whatever needs to be done to fund your retirement, whatever's needed to improve the viability of the farm for the next generation, the taxes are the end result. The taxes are what the taxes will be. There are some ways to shade it, and we'll talk a little bit about that, to modify it and to look at it, but taxes should not drive the property. Your retirement, senior generation should drive it. Viability for the next generation should drive it second, and then taxes are really more the byproduct. Next slide, Shemariah. All right, the next question I get asked, or I ask, is do you plan to retire? And the answer I get most often is, I'm going to keep working until I can't work anymore. I'm going to keep working until I drop. Well, that's good in theory. Hopefully, and most likely, that's where you may be able to achieve it. But again, somewhere along the way, you will retire either voluntarily or involuntarily. And the best way to figure out financially for yourself, and especially for that next generation, what your retirement is going to look like, is to set a date. It can be a little bit in the future, but you need to set some form of date. You can always extend that if need be, but you don't always know when you're going to retire. Are you going to have a heart attack, stroke, serious ailments? Are you going to just not feel like farming anymore? And the next generation, whether that's your family members or a non-family successor, they're not going to wait for you forever. They're going to want to take over the farm somewhere along the way. They want to understand what their options are. So that's pretty critical there. When does this start? The frank answer is the sooner the better. Most farmers become the identity of the farm. Their face is the farm. It's hard for them to envision doing something else, but somewhere along the way that's going to come. The sooner you plan for it, the longer you can extend that data out, and it makes it less intimidating and makes it more productive for yourself and for the next generation. I then often ask, how do you see yourself transitioning as you age? And again, if you look at retirement as something that has to be done in the next 6 months, it's scary, it's overwhelming, and to get your financial house in order is difficult. If you look at it over 5 years down the road, I want to be doing X. 10 years down the road, I want to be doing Y. It's less intimidating. Hopefully, ultimately, it'll get more exciting to you. I work with one farm family, and when I first met them, this was through a succession school with Land for Good. We talked about the senior generation who were in their early 60s. Well, how many days a week are you working? And Dad said, I'm working 7 days a week. I sometimes take off a half day on Sunday, but I'm always here. We tried to push them to go back to, well, what if you work 6 days a week? Oh, I can't do that. I have to be there at least a half day on the seventh day. Well, by the end of farm succession school, we got them thinking about, well, wouldn't really mind if I worked 5 days a week and had either weekends or exchanged with my 2 kids that are on the farm. The idea for retirement's getting a little more exciting. We've talked about the financial end of it. It's not quite as scary as it was. This was over a 3-month period. We took somebody from absolute terror that they wouldn't be there essentially every day to 5 days a week is appealing, and moving forward with the next generation, taking over more and more. So the sooner you start on that, the better off you are. And we're going to talk about some of the financial reasons for it. Next slide. How much do you need annually? That is the big question. And I've had answers in those 300 plus, anywhere from $45,000 a year as kind of a base cost to live on in retirement to $125,000 per year. It depends on whether you're single, married, whether you're in a rural area, metropolitan area, and it also depends on your lifestyle. So numbers are all over the place. We're going to go through a worksheet in detail to try to determine that, but that number is pretty critical to know what you need for that retirement. Part of that, and we're going to look at this too, is what does the farm cover now? Like many farmers, and like I had, the gas pump was there, so I filled up the vehicles with farm. We had meat from the dairy cows, we had milk, insurance costs were covered by it, some of the utilities for the house were covered by it. So the personal needs are often covered in part by the farm. When you transition the farm, and I say when, the farm may or may not still cover some of those items, but what you really need to know is, in that next life, how much will be covered by the farm? How much will you need to cover in your retirement? Where will you live? Does the farm have enough houses for both you and the next generation? Will you swap one house for another house, or will you ultimately end up off the farm? Where will you live in your retirement? And again, it's a personal decision. Some people want to move south. Some people want to stay nearby. Depends on family use, and it depends what that next stage in your life is going to be. Can you age in place? If you're in an old farmhouse and you're living on the second floor and you've got these steep stairs going from upstairs to downstairs, that may not work. If you're in a ranch house, it may be a little bit easier to do. Somewhere along the way, you're going to have some healthcare needs. Most important is be realistic. Next slide, please. This one is a slide that Mike had put together, and it makes me smile. This is the retirement smile. It is reality. On the left-hand side, you're still working. You need to fund an active retirement. You've got some needs. Are you going to buy an RV? Are you going to buy a boat? Are you going to be traveling a little bit more? You're probably going to have a fair amount of spending needs because you got an opportunity where you're not on the farm all the time. You may be spending a little bit more money. The bottom of the smile, you're not as physically able to get around, but you don't have a whole heck of a lot of health needs. You can get by on maybe a little bit less money. And then longer term, again, unfortunately, as we get older, I'm 63, so I've had the stents put in. I've had some heart issues. I never expected to, but again, these things do happen along the way. As you get in your 70s, 80s, 90s, unfortunately, there's more healthcare needs, and medical, as many and probably all of you know, gets more expensive. That smile on the right-hand side gets more expensive. You need to have some more money to set up for that. Next slide, please. You also need to factor in inflation. $40,000 today, you may say, yeah, I can get by on 40,000 bucks. Well, at 3% inflation, which is a little higher than where we're at, but we've been higher than that in the past. 10 years down the road, that 40 becomes 51. 20 years down the road, it comes close to doubling to $68,000. So, if you can live on $50,000 or $70,000 today, that number is going to be somewhat higher than that. I can also tell you from those numbers, I said it's a range of 45 to 125 in general. I've had people say 200, I've said 250. For a couple with medical insurance, with basic needs, some presents for the kids and grandkids, a little bit of travel, groceries, fuel, etc. $70,000 to $80,000 is pretty much a common range, and it's one I think is important to use just to make sure that you've got enough money set aside. You may have a little extra near the bottom of the smile, but as you move forward to those later years, you may need a little bit of additional funding to make sure that you're going forward. Next slide, please. I love this one. What are some of your options? The elder couple, we need to move back in with your parents. We hope that never comes to pass, and that's one of the reasons that we need to talk about that. I have seen people, unfortunately, who have have leveraged the farm. They've sold development rights. They've taken any savings, put those away. They borrowed from Farm Credit or other banks, and they've leveraged themselves to the point that they really cannot afford to retire. Don't want to see that for anybody on the call today. Next slide, please. All right, this is something everybody hates. One of my favorite farmers who I worked with for years, and he was pretty savvy overall, but I asked him to fill out a retirement budget, and he actually got mad at me. He said, I don't need to do that. Well, it turns out he didn't want to look at his personal living needs. He really just didn't want to address it. He knew how to do it. He understood it, but by filling it out, he was kind of admitting that maybe retirement was coming towards him and accepting a little bit of reality. I put on this first slide here just to show if you do save, the more money you're saving for a longer period of time, the better off you are. And the perfect example I've got for this is when I first came out of Cornell way, way, way back. My wife went to work for a community college as an intern. And unbeknownst to her, and actually to me, we were 22, 23 years old, the college she worked for had set her up for a retirement plan and automatically took some money from her paycheck to put into a savings plan. Well, she'd been there for 18 months, and it turns out that it was about $4,000 put into her for that period of time. They had actually gotten the address wrong. Somehow they corrected it, and we got a statement at the end of the year, shortly after she left, saying, oh, she got $4,000 in there. Great. Well, we took that money and invested in the stock and the bond market, and actually in another investment. And that investment, nearly 40 years later, is now worth $150,000. So from 4,000 in bad money we didn't expect, it's now worth 150. That's the benefit of compounding. So that's why I encourage everybody, start sooner rather than later. Use compounding is terrific. Next slide, please. And this slide is a little bit hard to read, but Shema, I think you've got it on what's on the Land for Good website, and I think you've also sent a link to it. So what this slide does, and we'll spend a little bit of time on here, is on the, there's two columns. There's the current and there's the expected. Excuse me for a second, caffeine. The current is where are you right now? What are you generating in income? What do you have in expenses while you're still actively farming? So if you look under the current, the left side, and then on the left side of the pages, you've got wages, Social Security, net farm income, other business income, rental, right on through. If you're still farming, you may not have any wages. Maybe a spouse has wages. You're probably not collecting Social Security. You should have some net farm income. Hopefully that number is positive. You may have some rentals, a collection of income. That will give you your total gross income currently. You take out of that your income taxes, federal, state, Medicare, Social Security taxes, and from that you're going to have your total net income. While you're farming, there's an awful lot of things you can do from an income tax standpoint. Section 179, write off some of your expenses, prepay. You work with your tax preparer. There's a lot of creativity that you can use to reduce your taxes, but that's what you're spending on living currently. Then you continue on down part two in expenses. Housing expenses may not be much if you're living on the farm. If you're renting a house, or if the house is off there, you're going to have some real estate taxes, mortgage payments, maybe rent, heat, sewer, right on through the bottom of the left-hand side under current expenses. You then go over to the right-hand side and continue that for current expenses, living, medical, health insurance, prescription. You may not have fitness programs because you're working hard, likely on the farm as is. Food, groceries, that's gone up a lot. Clothing, auto expenses, right on through. That will give you your total expenses. if you add the bottom half of the left side and the top half of the right side. You take the net income, that is your total net income minus total expenses. That's going to be your net income. Can you slide that down a little bit, Shemma, or that's as far as that page reaches, I think.
Looks like that's what it does.
As far as it reaches, okay. You take your total net income, you take off your total expenses. That is your total discretionary income. That basically is what you got left over as you're farming for an investment into the farm and hopefully putting some money aside for savings. So critical to do that. Easiest way to do that, if you have a separate business from your personal checkbook, just go through that personal checkbook and add up for 1 year what these expenses are. The income should be fairly straightforward. Net farm income, I would take that, what you got from the farm from a Schedule F, and take off the depreciation on that. If your personal needs are mixed in with your business needs, again, just go through the checkbook as honestly as you can, because again, this is for your benefit, not for your business advisor, to get a sense of what your income is and what your expenses are. Once you do that, then we're going to have you fill out or ask you to fill out the right-hand side in both columns, the expected. That is once you have fully retired, and again, for many of you, you'll go from fully working the farm to fully retired over stages where you may go from full-time to part-time gradually. But what we're trying to do is trying to determine what your real need is in retirement. And this is the best way to do it. So in the expected side, the right column on both sides, wages. As I said, you may not be working, but your spouse may be, the time your spouse is no longer working, wages may be zero. Social Security may be kicked up a long ways, and whether you're making $1,000 a month, $2,000 a month, most of you have been getting statements every few years, which are giving you expected Social Security in retirement. Use that number. Net farm income, are you going to go to zero? Are you going to do something like Mike does and do some maple syrup as a sideline, raising a few beef cows, or pick your own or something? Are you going to go stop entirely, or are you going to do something on a part-time basis? Other business income. I have one farmer, she's done Reiki for many years, and on a part-time, she makes $20,000 net income per year, does pretty well. Rental income. We have some stock dividends, investments. Will one of you have some annuity payments? Again, add up all the different sources that you have coming in on a consistent basis. Stock dividends, don't take the stock sale, take what you can expect in a typical year. That'll give you your total net income when you're retired. Take off the federal and state taxes, Medicare, Social Security, from that, and they'll give you your net income. Then you do the same thing for expenses in the expected. If you've moved from the farmhouse that the farmer's been paying part of the taxes to a house off the farm, or maybe you've got an off-farm house, maybe you got a house in Florida or somewhere else. What are the real estate taxes? Did you finance that? Do you have mortgage payments? Do you have some rent instead of owning the house? Heat, water, phone. It's insidious on these things. I filled it out for myself, and it's a little scary how fast it adds up. One of the quick story on why it's so important. I had a farmer, husband and wife, they've been dairy farmers forever. They had a son and a daughter. The son took over this farm, the daughter is involved with another dairy farm. I asked mom and dad to figure out how much they can live on. They said, we don't need any more than $45,000 per year. We get $45,000 a year, we're fine. They had a sand and gravel bed. And I said, are you sure? I think, and that was generating $5,000 to $10,000 per year. I said, I think you should keep going with the sand and gravel business for the near future, just to make sure. Oh no, we're fine. Our son can take that over. He needs the money more than we do. Within 6 months, they came back and said, 45,000 is not enough. We need that gravel money. We want you to tell our son that we need the gravel money again. Nothing like putting me in an awkward spot. So I talked to the son. The son said, that's fine if mom and dad need it, but I had planned on that money. I was doing some capital investments and equipment for the farm based on that. I'll have to change my plans. They give me this opportunity, no issue with it. but I wish they'd said that up front. So if you are too generous to the next generation and don't look out for yourself, that can come back to bite you. So be realistic, set aside a bit of a cushion, and see where that number really comes out. So obviously we're not going to go through that today, but this to me is probably the most important piece of paper, frankly, that you'll almost ever have, because this will hopefully set you up for retirement. And retirement these days, typical retirement is 65 to 70, and it's not unusual for people to live to be 80, 85, 90, 95, or even older than that. So if you retire at 70, let's say, and you live to be 90s, 20 years, live to be 95 is 25 years. Your retirement is probably going to be half or 2/3 as long as your working years. So you really need to be set up and ready for that. All right, next slide, please. What are some of the sources of retirement? Social Security obviously is the key one. As I said, I've looked at tax returns for a lot of years. I've been an income tax specialist since 1982. So as you can imagine, I've looked at a lot of tax returns. I've worked with farmers who never, ever, 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 ever want to pay taxes. So they always try to get their farm income down to zero. And some that have been a little bit more realistic than that. So the ones that have gone close to zero every year, when they hit retirement, their Social Security check is $800 to $1,000 a month, which means they're getting $10,000 to $12,000 a year. Not a whole heck of a lot for retirement. I've also seen the ones that have $25,000 to $30,000 per year in Social Security income. Now you're talking $2,000, $2,500 a month. With spouses in there, it can be $3,000. I've seen as high as $4,000 a month. That'll pay a lot of bills. But that's one of the key items that's there is Social Security. Investments. Hopefully all of you, though probably not, have some money set aside in IRAs, stocks, bonds, savings. Like my analogy with my wife, the sooner you start saving, putting some money aside, that will be there for you in the future. Many farmers have told me, and I understand it, that the farm is their retirement. Well, that's good as long as the farm generates enough money for your retirement and to take care of that next generation. If you're counting on that, hopefully it's there, but we're going to talk a little bit about that. It may or may not be. And we're going to talk about some of the options, some of the realities with that. Spouse's retirement income. Did the spouse work for the post office? Was the spouse a school teacher? Did the spouse have some form of wage during their lifetime that they got a retirement income? Take a look at that. Are you going to keep working? Are you going to phase from retiring from full-time at 65, work on a part-time basis till you're 70, and then retire from there after that? You may be able to factor in some additional income for working a sideline. Do you need to sell some of the farm assets, livestock, real estate? Are there some real estate? Are there some house lots that are not critical to the farm that you could sell off if you needed to? Is there more equipment that's necessary? Was the farm a dairy farm and now it's switching over to a beef farm? Is there certain assets that could be liquidated? Could you rent out part of the farm either to the next generation or to someone else to generate some revenue? Or could you sell it conservation easements? And we're going to talk a little bit about that. Next slide, please. Young farmers, pay attention. And we've talked about this. A myth that has gone around is that Social Security is based on your last 5 years of earnings. People have said, I don't have to pay much in the last 5 years I'm farming. I'll put it at the max rate and then I'll have a nice Social Security retirement. Wrong. What the rule is for Social Security is the IRS will take your top 35 years of earnings and base it on that. Now, you can say, well, this year I made $30,000. 35 years ago, I only made 10. What the IRS does is they take the earnings at that time, basically adjusted for inflation. So let's say 35 years ago, you made $10,000 profit and the maximum Social Security earnings were $20,000, the max that you could pay in. Well, that year you paid in 50% of what's possible. Let's say this year you paid in you had $40,000 net profit. Well, this year you can do $130,000 as your maximum. So that means that less than a third of your earnings compared to what could be paid in were paid in. So they look at the 35 years. So I know people want to avoid taxes, but they need to pay over the years in order to qualify for higher levels. If you pay in more in later years, it will help, but the last 5 years is not going to change it a huge amount. Don't worry as much about tax avoidance. Try to balance that out as much as possible, because it will catch up with you. All right, next slide, please. Other forms of income. People like to have some funds working to reduce their taxes. There's the traditional IRAs, there's SEP plans, self-employed pension plans, there's simple IRAs, there's 401ks, there's a lot of different ways to do it. It can reduce your gross income, reduce your taxes. Hopefully, many of you have taken advantage of it. Those numbers, again, through compounding, can add up to a pretty significant number. One of the favorite farms I work with consistently put in $7,000 to $10,000 every year between he and his wife. He's got a nice chunk of money by now that he does not need to rely on the farm as really for much of anything to support it. He's also got that available for other family members. So again, I know it's the desire is to avoid taxes. This is one way to do it and do it productively. Again, I know the desire is to invest in the farm, and I strongly encourage that, but you also need a nest egg for retirement. Next slide, please. Another great slide, investing in financial planning. And I've had people come to me about this. I retire on Friday and I haven't saved a dime. Here's your chance to become a legend. That's a little bit too late. If you look at the IRS statistics and studies, the average person when they are in their 50s have saved about between 40 and 50,000 bucks. Pretty simple math, it's not enough. You gotta save early, you gotta save consistently to have that nest egg for sometime down the road, because you just don't know where it's at. That day, it's just not enough time. Next slide, please. Again, start early. What's the right funds for you? This is not an investment class. That's its own effort. I stay away from investments because there's many different options out there. Which are the right ones? But I'll give you the basics. Start early, take advantage of compounding, as I've talked about. Contribute as much as you can, even if it's a small amount. Put in, younger years, 20s and 30s, put in a couple $100 a week, put in a couple $100 a month. Work forward on that. Watch out for fund fees. Annuities are one of my non-friends. Look for the fees that are out there. They can add up pretty quickly. There's socially responsible funds that are out there that invest in farms, farmland, different forms of agriculture. If you're not a big fan of some of the crazier ones, socially responsible funds are a good alternative. Look for the asset allocations. Try to balance stocks, bonds, try to figure out a balancing act. And again, what I encourage people say, oh, I'm going to be retired at 65. I need to have everything as cash, or I have to have everything as bond funds. You're not going to die tomorrow. You're going to be around probably for 20, 25, 30 years. So you want to have that balance between stocks and bonds. As I said, I'm 63 years old. I'm 60% stocks, 40% bonds, because I'm not going to start drawing that money for a few years, and I hope to draw it for the next 30 years. So I don't want to be too aggressive. I don't want to have 100% stocks, but I also don't want to have 100% bonds or CDs or cash. Somewhere in between is the right answer. As you get older, you want to move more conservatively, but that should happen in your 70s and 80s, not in your 50s and 60s. One of the best rules, and we're going to talk about this a little bit further, that I've used over and over again, is the 4% rule. And it's kind of a standard benchmark. It's not perfect, but it's a good way to budget. What I mean by that is, let's say you've got $300,000 in your savings account. If you decide that you can take out 4% every year, 4% of $300,000 is 12,000 bucks a year, or 1,000 bucks a month. If you do that, that's going to last you effectively the rest of your life. If you look at it simply, let's say you don't get any interest whatsoever, zero interest. That $300,000 you draw out of $12,000 per year at 4%, principal alone is going to give you enough to do it for 25 years. So if you get 2, 3, 4%, very easily can you take that money out for 30, 35 years or longer. So kind of a rule of thumb. So if you If you got $500,000 in savings, retirement funds, liquid assets, that is going to be 20 grand a year. If you're lucky enough to have done saving, put money aside, and are able to get up to $1 million, that's 40,000 bucks a year. That's a nice nest egg. So clearly the benefit of it. All right, next slide.
John, if I could just step in for a second, just to give a little bit more emphasis. The reason that watch asset allocation is in capital letters is because the farms that I've worked with, and when people started to set up a savings plan for themselves, IRAs and so forth, this is one of the things that I see most often that farmers fail to pay attention to, because they set it at the beginning. They do make the contributions, but they had it set when they were young, where it was very heavy in stocks and not in bonds and money markets and other things. They're more safe as they get older, and they'd not paid attention to that. And it looked this time last year like we were all going to lose quite a bit. Of course, my IRA recovered and went past where it was in the end. But I think everybody can think back to 2008 when the crash came, and then people who were too heavily in stocks, it lost their nest egg and weren't able to retire when they wanted. And it's one of these things. I think it's so easy for farmers to just, there's so many other things to think about, but to forget about. And the rule of thumb that's mentioned in that slide is generally, and John's kind of was an example of it, and again, this is just a rule of thumb. It's not perfect, and you really should talk to a financial advisor about your particular situation and what markets are doing at the time, but it's to take 100 minus your age, and that should be the percentage that's in stock. So, John gave the example of being about 60-something% in stocks, and then the rest in bonds and something that's more secure. Some people will lower that to 80 because they want to be more conservative, and some people think they might live longer. They want to catch up, and they'll try to raise that to 120, which would be much more risky, and some people would have to take that into consideration. So part of it is your risk tolerance and what else you've got going on.
Yeah, no, excellent point, Mike. And the other benefit is if you work with a financial advisor, and most Fidelities, Morgan Stanley, on and on and on, have financial advisors. They have portfolios that will adjust as you age, so that you can set up a portfolio that's 60-40 when you're 60. As Mike said, maybe it's 70-30 bonds versus stocks when you're 70, and so on. So you don't have to do it. You have to be aware of it, but there are experts out there who generally don't charge you for that anymore to balance the portfolio, watch that asset allocation. So excellent suggestion, Mike. Next slide, please. Assets and conservation easement sales, understanding the tax implications. And again, I know this is an important topic. Tax rates have gone up, they've gone down. Capital gain currently is at 15% for most sales, up to significant sales when it maxes out at 20%. This is on a federal level. Taxes likely will change over the next few years based on the financial challenges that we've got. But tax implications are important to understand, to figure out what your net number is if you're going to sell a conservation easement, if you're going to sell some assets, important. But again, don't let the tax implications drive it. There's also many ways to modify the taxes. Let's say you decide you're going to sell a piece of land, put it into savings for retirement to set yourself up, and there's going to be a $100,000 gain, let's say, on that. Well, if you plan ahead and you're still farming, you may be able to do some prepayments, you may be able to buy some equipment, you may be able to make some changes that, let's say you can adjust the farm income by $50,000, reduce it by $50,000 lower than it normally would be. There you've offset half of that gain and turn that gain into a smaller number. So understand the tax implications. Again, work with your accountant. That's what they're there for. It's not only compliance and doing the tax return, but helping you plan ahead of time for what's coming in the future. I like to spend more time, frankly, in my tax practice with clients planning for what's going on in the future than what's happened in the past. Actually, I had an example the other day of a potato farmer who's looking to sell a house, and he's talking about like-kind exchanges to buy some replacement property, talking to me before the sale so we can look at what some of the options are. Again, you can plan to minimize taxes. Oftentimes you can't avoid it, but if you can limit it, you're ahead of the game. Easement sales are taxable events. Let's say you bought the farm years ago for $100,000. It's now worth $300,000. And let's say they're going to give you a $200,000 for conservation easement. Where you bought the farm for $100,000, if you can allocate most of that to that sale, for that sale price of $200,000, you've got a $100,000 tax basis. That $100,000 gain is taxable. If you sell that easement for something less than fair market value as a discounted sale, there is a conservation easement that you can take on your tax return to help ease that. And that's the difference between what that easement is worth technically based on the appraisal and actually what you're actually getting for it. In most cases, I've seen easements over the years. I covered Connecticut, Massachusetts, Rhode Island. Generally, the government and private investors will pay typically 80 to 85% of what that value is. So that last 15 to 20% can be a deduction. Again, fairly complex. If you get to that stage, talk to your tax preparer. Debts that sit out there need to be addressed whenever you're looking at either conservation sale or a sale of assets, because that bank is going to want to get paid if the asset that they are controlling has a decrease in value. They may or may not require full proceeds. Again, talk to your banker if and when you get to that stage. Conservation easements typically will take 2 to 3 years. I'm not sure in Vermont, Mike, it's kind of the same length time to get to that stage.
Yeah, easily.
And I think that's kind of there. So it's usually not a surprise. You know, talk to the banker, talk to your accountant, talk to your attorney sooner than later, and get it figured out what the repercussions are.
So John, I think too that just even without the conservation easement, but the sale of any of the assets, non-real estate assets as well as real estate assets, but those levels of debt play a significant role in a lot of the farm transfers that we work with, and being able to bring debt levels down prior to a transfer can be helpful, because of course there's going to be a more of a net return for someone to use for their retirement, but it also can play a factor too in what the buyout looks like for the next generation, because that lender is going to be at the table, and you could gift your equity to the successor, but you know, the debt is still going to have to be addressed. And if you're trying to raise money for retirement, and now the next generation has to buy your equity and take over that debt, that's where some of these become difficult to make cash flow for people. And so controlling that debt can improve what you have available for your retirement, but also make it so that you might be able to structure the deal more easily for the next generation to be able to cash flow a purchase.
Absolutely, good point. The other trick to debt is that if the debt is transferred from the senior generation to the junior generation, that is part of the sale proceeds. So let's say the farm has $250,000 debt on it, and mom and dad are relieved of that debt. It goes now down to junior, and no other money changes hands. That's a sale for $250,000. That could be a taxable sale. Mom and dad got nothing other than being relieved from the debt, and now suddenly they've got a tax bill for that relief of debt. So got to be aware of that, and it can bite you. In a case like that, what often happens is, let's say that debt is $250. Mom and dad may say, well, we need $100,000 in cash plus relief of the debt. The $100,000 may be used to pay that debt off and put some money aside, or pay the tax on that debt and then put some money aside. So debt can catch up with you. So be very aware of it. It can be structured in there, but then you need the lender's agreement to transition that debt if the senior generation is not paying it off themselves. This last statement here.
Mike and John, there's a comment in the chat about conservation tax credit programs that states might have. I don't know if you want to look at that. Rebecca is sharing that states may also have conservation tax credit programs, but their funding is always behind the demand. So you may need to get in line early. And sometimes the credit is only a 5-figure credit, which to this writer seems like a lot of work for little return, but it still could be worth talking to the state staff about and seeing what's available.
Absolutely. Yeah. generally not too significant. There has been some discussion about the ability to transfer farms to the next generation with a larger tax credit on the federal basis. I was part of a national group to do that, but again, it's been discussion, nothing beyond that. So always look for opportunities and options. Your accountant hopefully is aware of different programs, Land for Good and others are also, so be aware of that. But the tax, again, stepping back on a big picture, you're not going to go higher than, on capital gains, you're not going to go higher than 20% federal under the current law. And most states, you're not going to be over 5% in this Northeast region, which means in the worst case, you're going to be paying 25% of the sale proceeds in tax. Likely it's going to be 20% or under. So even if it's 25%, you still keep 75%. I've had people say, I just don't want to pay taxes. I hate giving it to Uncle Sam. But I say over and over again, you've avoided Uncle Sam over the years. You've had the benefit of the tax things that you can do, such as quicker write-off, prepays, etc. Uncle Sam has been very patient with you, but now they got their hand out when you're cashing in. Deal with it to a certain extent. It's a reality of life. We try to minimize it with federal state program, conservation easement credits, but it is part of the process. This last statement on the slide is one that Mike has, which I really like. Easement sales can only fund one generation retirement during perpetuity, and that's a long time. So you can't use an easement sale to fund senior generation and then have it available for the next generation. It needs to be looked at very carefully. There are certain times it's appropriate and there's certain times it's not. But take a look at that. It's a substitution of assets is really what it is. In that statement I had earlier, if you got a farm worth $300,000, development rights are worth $200,000, and the farmland, strictly as farmland, is worth $100,000. You now, with rights intact, have a $300,000 asset. If you sell that development rights for $200,000 or close to it, you should have $100,000 land with a restriction, $200,000 in cash, minus some taxes. So you should have close to that $300,000. If you take that $200,000 in proceeds and spend it not wisely, let's use that term, so those $200,000 is gone. Now you have $100,000 land, restricted land, and no other assets. Not the way to go about it. So use that $200,000 proceeds prudently to pay down debt, maybe buy an investment that has a good return, or put it in for retirements that are used appropriately. Great. If it's not used appropriately, that development rights potential is gone, not available for future generations.
Yeah, and I put particularly emphasis on this because I definitely seeing this here in Vermont, where conservation easements went in the 80s and 90s, and now the next generation, or that generation that benefited from that easement sale in the 80s and 90s, are getting ready to retire, and they didn't do any retirement savings over the last 30 years, and so they can't do that sale again. And of course, we've only accelerated since the 1990s the amount of easements that we're selling, and these next generation, and it's very often part of it is helping get the older generation a retirement as they leave, and that younger generation really needs to be paying attention that they're not going to have that, and they need to be paying attention to these other things that we've been talking about as far as where their retirement might come from.
Yeah, oh, absolutely. And some of those were sold in Massachusetts in the early 80s, were sold for $1,000 to $1,500. Now they're worth $10,000. And I've talked to some farmers who kind of kick themselves saying, I wish I'd held off longer. I could use larger funds these days. So again, used appropriately, great. And I know a lot of farmers want to be able to preserve that farm for perpetuity. They can do so without conservation easements, but the conservation easement can generate some cash, again, if used appropriately.
So John, there was one more thing on this slide. And again, this isn't just pertaining to installment sales, but assets in general, to sell assets in general. But, one of the things that can help both the older generation from the tax standpoint and also the younger generation from a cash flow standpoint is when installment sales are used. I don't know if you'd want to expand on that at all, John.
Sure. And this was one of the installment sale, that's a good point. I did miss that. can be used in many different ways. I got a very specific example. I had a cranberry grower. He decided to retire at about 65 years of age. His son was about 30 years of age. He had done very well for himself financially as far as saving money, but he also had a daughter who was not involved in the farm. So what we agreed to, and the son also very strongly supported this, is that we said that the son would pay the dad $4,000 per month for the rest of his life. That $4,000 per month was given to dad. Dad then had that money available to give to his daughter, so that there was a more equitable balance between the son and the daughter. Because dad did not necessarily need that funding. If there was a tough year in the cranberry industry, dad, in an installment sale, you can't forgive the interest as far as taxability, but you can forgive the principal payments. So if there was a tough year, dad can say, son, this has not been a great year in the cranberry industry. Pay me the interest, but don't pay me the principal. So it gives the flexibility to forgive those payments. I personally also think it's a good training tool for the next generation. If mom and dad are too generous, give that farm to the next generation. That younger generation doesn't have quite the financial incentive to push to cut costs, to be as financially aggressive as they may need to be. By having an installment sale in place, it provides some additional funds for that senior generation, maybe to take care of the other children, but it also puts some financial discipline on the younger generation to be more careful with their funds, push prices if appropriate, cut costs as appropriate, and run a leaner, meaner operation. The day that installment sale is done, they put themselves in a better position. Yes.
So one more point to give some emphasis to is just with an installment sale, there could also be consideration of that older generation discounting the asset value with the knowledge if the payments are made according to the amortization schedule, that you could make back what you're discounting in interest over time and end up in the same place financially, but give that next generation a better start by not having them have to pay for the full asset value.
Yeah, absolutely. And the other benefit is if you do it as an installment sale, generally that senior generation is going to be in a lower tax bracket. With capital gains, if you make roughly less than about $300,000 under currently, the capital gain rates, less than $300,000, you're going to be in the 15% tax bracket. If you get your income under $100,000, you can potentially avoid capital gains altogether. So it can be a tax planning tool. Again, the senior generation does not get the proceeds as soon, so they're not able to invest it as soon. But tax savings, as Mike said, giving the younger generation the flexibility to buy the farm over a period of time provides an awful lot of flexibility. So I'm a strong proponent of the installment sales. Again, they got to be used prudently. If there is debt in there, that debt typically needs to be dealt with up front. But installment sale can be a really good tool, again, if used appropriately. All right, let's move on to the next slide. Shema. Healthcare, another topic that nobody wants to talk about. Medicare comes in at 65 years of age. It will not cover 100% of your costs. There's something called the donut hole. That is about $3,000 to $4,000 in medical coverages. Basically, what that means is that you have a few medical needs, you got some prescriptions. Medicare will cover the earlier amounts. If you then have some hospitalization, more significant doctor bills that exceed $3,000 to $4,000 as a rough number, you're going to be responsible for that $3,000 to $4,000 in costs under that donut hole. And then if you have some significant medical bills, that can add up pretty darn quick, but the Medicare will kick in for that and cover the big bills. It is a surprise on healthcare. I worked for Farm Credit, as I said, for 37 years. Farm Credit covered most of my health insurance costs. I retired and now have to cover my own. That's $1,600 a month for family coverage, nearly 20 grand a year. So It's not insignificant, plus the cost of prescriptions and other costs. Medicare will, I'm 63 right now, when I get 65, I get a raise because I won't have to have the higher cost insurance. I'll have Medicare, I'll have some supplements. So I'll go from $20,000 a year, probably down to 10 grand a year. People get confused between Medicare and Medicaid. Medicare is for anybody that's 65 or older for short-term health coverage. Medicaid is for that long-term care, either in the home or if you need nursing home care. One of the things to look at is, what is your family's health history? You know, did your mom and dad have strokes? Did they have heart issues? They have cancer, Parkinson's, or were they healthy and they lived to be 95 and didn't need any medical coverage or any ailments, any prescriptions until they're 90? You know, look at that family history and try to figure out where you're at, what your future is going to be. Another good one. I was planning on using my assets to pay for my long-term care, but then I realized there was not enough change in my couch. It doesn't go as far as it used to. Insurance is not cheap. Insurance has gone up a lot over the last few years, and unfortunately, it's not going to get a whole heck of a lot cheaper. There's a lot of coverage that's out there. What the future will bring is a little unclear. Okay, Mike, could you step in for a quick? I just got to sneak out for about 2 minutes.
Sure. So, you know, as John said, there's a question of like whether or not you're going to be the person who makes it to the end with minimal care or care that's outpatient, you get to be home, or that if you end up being someone that needs to be in long-term care. And that's one of the, I think, one of the biggest concerns that comes up with farmers. You know, I hear all the time, it used to be that we used to hear people, it was like, well, I don't want to have to pay estate tax. Well, now people realize that the estate tax, at least on the federal level, is a pretty minimal concern for almost no farmers here in New England and much of the country. Though there are some states with estate taxes that still play some role, including here in Vermont. And but even that, the exemption was just raised. And so the concern that we're hearing more often now is about losing their farm to the nursing home. And of course, part of being able to address that is first and foremost thinking about your health all the way through, and not avoiding health issues, but also thinking about, as we talked earlier, about what is can you age in place? What is the home situation like? Is it a place that you could stay in? I tell people about my father died in 2019 at age 80, and he was in a wheelchair in the last 2 years of his life, but he lived on one floor. That my parents' house was suitable for him to get a wheelchair around. We made a number of modifications, including some ramps and so forth, and my mother was available. I was nearby to provide care. Some cases, many times people avoid long-term care by being able to move in with family. So there are things first to do to potentially avoid having to pursue a nursing home. But that's not avoidable for everyone, and particularly for certain situations. As an EMT, I see dementia patients frequently where it comes to the point where they just simply can't live at home because of they either start to wander and then we're going out and searching for them, or they start to become violent against their caregivers. And so a nursing home becomes inevitable. And of course, there's less dramatic reasons for that as well. The fact is, the nursing home doesn't want your farm. They just want to get paid. And so thinking about how they could get paid is important. A lot of times the consideration is to draw down assets towards being eligible for Medicaid, but that is complicated, particularly since the government doesn't want to be paying for someone's Medicaid who has the ability to make those payments. And so they look at back 5 years for asset transfers to see if someone was transferring assets in anticipation of having to go into a nursing home and expecting that they wanted Medicaid to cover it rather than their own costs. And so this plays a role in some transfers. I'm working with one right now where that's particularly a concern. And part of addressing this is to work with a good elder care attorney who is familiar with the Medicaid rules. And there's also the potential of looking at are there means that you would have in order to pay for any of the care, because it's not necessarily an all or nothing situation. In many cases, the way you structure the farm and the asset transfer can be important to being able to protect those assets, particularly the real estate. Next slide. So I just discussed, most of this. There is some life insurance policies out there. I'm only cursory know about this, but there are some now out there that are a combination of life and long-term care products, because the long-term healthcare insurance, almost no one buys it because it's so expensive. You don't even think about buying it until you get towards that age where you might use it, and then it's even more expensive. So these hybrid products that are out there are supposed to be one or the other, where you might choose to buy it because you don't know that you're going to need long-term care. And so you don't necessarily want to waste the premium on something you may never use, but these policies will convert to a life insurance policy. If you don't use it for long-term care, there's still a payout at the end. And so it'd be something to talk with your insurance agents about it.
Thanks, Mike. I appreciate that. I've had some specific experience with that. Both my mother-in-law and father-in-law, who were teachers, had long-term care insurance, and they had different products. My mother-in-law, she had a higher the payment. It paid $188 per day towards nursing homes, but it only lasted for 3 years. And I can tell you, she paid in about $80,000 over the years, and she collected about $80,000 before she passed. So she broke even. My father-in-law also paid in pretty close to $80,000 a year. His policy pays about $152 a day, so a smaller amount, but his is a lifetime plan. He's been on it for a little over a year now. Stay tuned as far as whether he'll make it through there. The daily cost of nursing care is slightly over $400 per day, so $150 or $180 sounds like a lot, but nursing home, unfortunately, at $400 a day is about $12,000 a month, or about $150,000 a year. So the numbers can be pretty significant. Statistic-wise, about 1 in 6 people end up going into a nursing home, and people that do, about the average stay in a nursing home is about 16 or 17 months. So 1 in 6 of you may end up in need nursing care, and those that do, on average, 16 months to $12,000 a month is about $200,000. So that, in general, is a financial risk. But again, I'm sure some of you know people who've been in nursing homes for many years. That number can add up pretty significant, and that's why it's important to look ahead of time at your farm as a primary asset. Is it important to stay in the family? Is it important to get long-term care? What's the right balance? And with that, we've been at it for just a little over an hour. I want to stop for questions. And then I've got 4 case studies, examples, very different ones that we want to kind of use to discuss what we've talked about so far. So Shema, do we have any hot burning questions at this point? Or should we go into the case studies?
We have one from Bob Woods. What is the maximum that Social Security will pay for an individual? I don't know if that's a...
If a person has paid in the maximum over the years, at 60, they can start collecting as early as 62. But if they start collecting at 65, they're going to be getting about $3,500 per month, so about $42,000 per year. They can wait. It kicks up by 8% for each year they wait. So they can wait, and that grows until you turn 70. Once you turn 70, the highest I've ever seen, I think the maximum is close to $4,500 per month, which is over $50,000 per year. So the lowest I've seen is about $750, and the highest I've seen is $4,500 per month. So it ranged from $8,500 for the year to a little over $50,000. for the year.
And one of the kind of sad things about that escalation between 62 and wherever your full retirement age is, and then up to 70, is that the Social Security Administration, based on actuarial tables, calculates that no matter what age you take, they will pay out the same amount by the time that you die. So they'll pay you more when you get to 70, but you've got less years before you die that you will get paid out. So they will ultimately pay out the same amount to every individual. The key is to beat the actuarial table and live a lot longer. You know,
Exactly.
that's where waiting, that's where it really pays off.
I've heard and read that it's about an 18-year period. If you live more than 18 years after you retire, you're going to be ahead waiting. If you live less than 18 years after you retire, you would have been better off collecting earlier. So what's the crystal ball say? That's look at the family history.
But I have seen people factor that in when they have known health issues that have already presented themselves in their 60s, and so they might be able to act. That crystal ball might be a lot more clear for them.
Right. Exactly. Any other questions, Shema?
Not that's coming through, no.
Okay.
Feel free to keep adding questions, and we'll get to them after the case studies.
Yep, we'll do 4 case studies.
I have one comment.
Yeah.
I'm Tim Taylor. Mike kind of knows me.
I definitely do, Tim.
I had one comment about Mike's comment about the conservation easement. I think here in Vermont, and I think it might be true elsewhere, if you've created a very viable farm, it's an asset that is very difficult to undo and later sell for development. We had just 8 acres down the road here in Post Mills, our little village in Thetford, where it was being farmed, and they wanted to put affordable housing in there, and the town went nuts over it. In fact, it was the town trying to develop the housing, and then when the neighbors went crazy about developing even 8 acres of prime ag soil, it wasn't possible. So I think in our case, we conserved our land because we wanted to maintain a viable farm, and I don't think anyone would ever let us develop our land even if we wanted to. So just a comment. I don't know what you all think about that, but I think it would be difficult if we wanted to.
I think
so you might conserve.
the only thing that I'm seeing come up is that there in more recent years, at least here in Vermont, is that the policy in the Vermont Land Trust and Vermont Housing and Conservation Board has been if a town designates in their planning for an area to be a growth center or a village center, they won't buy the conservation easements in those areas because they don't want to interfere with town planning. And I think that's a larger policy discussion maybe we need to have, because sometimes the planning in certain towns isn't better than is not as good as it could be. But I think in general, they're saying if we want these compact village centers, we have to allow the development there and focus on protecting the land that's outside of them. And certainly where Tim's farm was outside of where outside of the village center, or any of the village centers in the town of Thetford. And so I think for many farmers that aren't anywhere near that kind of situation, or in other states where those policies don't exist, selling the easements could happen at almost any point as long as these programs continue to get funded. And that's where I would continue to advocate that people look at the sale of the development rights as a one-time thing that they do when it is the most sensible thing for the farm and the family. Because in many cases, since you only do it once, and if there's a next generation's coming along that has the same ethic to keep the land and farming, has the same capabilities, and has a good business, that's the surest way to keep it in farming. And if you can hold that card and wait to play the card to sell the easement when it makes the most sense, either there's different development pressure or other issues, or there's not a next generation coming in to take care of the farm, or there's concerns the next generation may not have those same ethics, then there would be plenty of other reasons. And there is a point at which many farms, it does make sense to sell the conservation easement.
I guess I would add one caveat to that, is that the farm needs to be profitable. Never sell a development right to substitute for profitability. If you're using those proceeds to subsidize the farm, that's going to catch up with you sooner than later. I had one farm that sold their development rights for nearly $1 million. This farm was owned by grandpa. Grandson was running a small dairy operation. After the conservation easement, the milk check was, or the feed bill was bigger than the milk check. And you can only imagine how big in debt they went. Within 3.5 years, those development right proceeds were used to keep the farm afloat, ran out of funds, borrowed some money, ran out of the ability to borrow, and had to sell the dairy herd. And the farm is struggling right now and no longer has the option to sell for development rights. So don't use it to subsidize the farm. The farm has to be viable. It's absolutely critical.
Joan is asking a clarification about the conservation easement, Mike.
Yeah, and again, this is a Vermont policy. It's only something I've seen come up directly. There has been, I was just working on a case actually in Starksboro where it had to go before the village, before the town planning board. And if the easement sale was going to go through at all, the planning board, because it was a designated village center, the planning board was going to have to approve it. And it ended up being a negotiation where the town wanted 5 acres kept out for out of the easement for potential development, but other land that was conservable, other land that was actually prime ag soil that could be, that was in the village center, they were going to allow to go forward, or they were going to say to the land trust and to the Vermont Housing Conservation Board that they would approve of that being conserved despite the fact that it was in the village center. So this has only been recently coming up, and I think it is a larger policy discussion we need to at least have here. I don't know if it applies in any other state.
No, I think conservation easements are appropriate to look at until you sign the dotted line saying you're going to do it. It's a discussion. Typically, the conservation agency will fund the appraisal price. So don't be shy in looking at it as an option, but make sure that you understand all the ramifications of it, taxes, restrictions to it. So it's a tool in your arsenal. Keep it available.
John, I think we should move on, or we're gonna.
Yep, let's move on to the first case study.
Okay, and we'll try to get through this so that if people, thanks Tim for sharing your thoughts and coming on, and anybody else that has that, we'll get back around.
Okay, let's do case study number 1. And these are 4 very different cases. I'm pulling them up just to get everybody thinking, and they may relate. Hopefully one of the 4 relates to your business operation. Case number 1, dad and mom are in their late 70s. They got many kids, but only one is on the farm. Farm earnings are thin. What flags does that raise? Limited other assets, so there's not much else that they could sell to fund their retirement. But they do want to see that farm as a legacy. So the mom and dad want to see it in farming as long as they can. They got the weakness of the thin earnings. They got several kids and they want to try to be fair. And they're in their 70s, so they've waited a long time. So next slide. What have we learned? Oops. Okay. Can you go back 1 slide? I thought I had that.
Yeah. Oh, we went too quick. Sorry.
Yeah. Okay. Yeah, each one we got lessons learned. So what are the lessons we learned from that first one? First of all, they had many meetings with the various experts. That's good in that they were looking to different people to get some expertise on taxes, attorneys, appraisers, etc. It's bad in that they kept looking to experts and not made a decision. They looked at options from an LLC to an irrevocable trust. What are some of the options that were out there? They asked for more options. They asked for more options. They asked for more options. They just could not pull the trigger because it wasn't the perfect option. So they ended up doing nothing. Not the source you want. And as you can imagine, parents are in their 70s. That means the next generation are in their 40s. Too late. As I said in the first one, ideally 65 to 70 for the, or start at 55 to 60 for the senior generation, 25 to 30 for the younger generation. This family waited too long. Let's go to study number 2. All right, this was a non-family successor. This was a dairy operator and a cheesemaker. They were consistently profitable. They had 3 children, not interested in the business. One helped out, but was not interested in long-term basis. They had another one who did some carpenter skills, but also was not interested in a long-term basis. The farmer had been helped out when they first started in their early mid-20s. They got some FHA money. In those days, the Young Beginner Farmer program in the 60s was very generous. They wanted to give a farmer an opportunity to make it happen. They wanted to, at the time they started, they were in their early 60s. They wanted to be retired by the time they were 65, 66. They did not want to stop suddenly. They wanted to ease into it. So they wanted to find somebody that would incorporate them into the business. What were the lessons we learned on that one? It's difficult to find the right match. If you got a dairy farm, you've got a certain set of skills. If you got a retail stand, you've got a different set of skills, more on the retail. A dairy farmer is more of the wholesale. This one, which was a combination of dairy farm and cheese business, also had a composting business, had a number of different talents that were needed, both wholesale, retail, marketing, accounting. It was tough to find the right match. There were more issues to be resolved than with a family transfer. Mom and dad transfer to the next generation. You can do some discounts, as Mike talked about, because you don't necessarily need to get top dollar. When you're going to a non-family heir, you may not need to get top dollar, but you want to get a fair price. So they were looking for somebody outside the family. They also wanted to start with a trial period and work towards ownership. They actually found somebody, had that person on there for a month, and personalities clash, styles clash, so they had to stop and start all over again. Ultimately, the trial period worked out great with the second one that was there. They discovered that it was a perfect match, and it's been a perfect match to today. The person who sold the operation still is involved in the composting business, still is there a few days a week helping out, happy as can be, great transition. It's a great opportunity if successful. Again, one of the biggest items that helped with that success was the business was financially strong enough that it could sustain both the buyout and the next generation. Financial viability was there. Let's go on to number 3. Development rights sale. This is one where it was a 14th generation farm. You can only imagine the pressure to continue the operation for as a legacy for the future generations. There were 3 siblings, unfortunately, who couldn't agree on what that future of the farm would be. The next generation was established on the farm, so one of them was there, 2 of them were not. There was not enough cash that was there for the buyout, so they need to use the real estate to settle the non-farming children. So the sale of a development right, in this case, where the farm effectively was a legacy already with 14 generations, 15th generation coming on, conservation right made sense. What did we learn from this? What lessons learned? Development proceeds can be a good tool to settle the ownership. It provided some cash equity to pay the non-farming children. As Mike had said, can only be used once. But again, in this case, it was a one-time sale that worked. It took time. It needs some negotiating skills. The first round of the conservation easement didn't have all the bells and whistles that were in there. The people at the next generation who had taken over wanted to do a little bit of agritourism. The initial conservation easement restricted that too much. So there were some negotiations. It was written a little bit more expansively. And ultimately it worked, again, with some help to get it resolved. They went to an attorney who had some good experience in conservation easements in that specific state. That person said, you're not going to change certain requirements, but you have the ability to change some other ones. He provided some insight, and it was very helpful to make that work. Proactive planning was better. Again, it took several years to get to that stage to go through this. The senior generation could plan for their retirement. The younger generation could plan for what was their future, the ones that were actively on the farm, and the ones that were not in there kind of understood the process and were financially rewarded ultimately. Let's go to number 4. This one is kind of the ideal location, my ideal. I've talked about it a few times. It was a successful pick-your operation, strong earnings, makes everything a heck of a lot easier. Parents, when they first started in the mid-50s, son started in the late 20s, they were willing to transition over a 10-year period of time. 10 years gives that senior generation the time to look at what their future is, where they're going to want to be. It gives the younger generation the chance to learn. They took our Generation Next class through Farm Credit East, gave them some skills. They picked up increasing responsibilities so that by the time those 10 years passed, this younger generation was more than ready. The senior generation was more than ready to back off. And there were adequate assets for the next generation. I don't think I told the story of the last class, and I'm going to tell it again. I was out there after nearly 10 years, and I went out with Dad to this busy agritourism. I went out there probably one of the busiest days. Dad said, watch this and follow me. He picked up 2 deck chairs. He had on this big straw hat. We took the 2 deck chairs, walked right near where the retail store were, and we put the chairs under a tree in the shade. We both sat back, and we saw the son with one of the assistants dashing back and forth, helping customers, talking to the employees, going in the store, going out of the store. Dad looked at me and said, it doesn't get any better than this. Got to see his son succeed. He got to see the business thrive. He got to have the changes. It took him time to go from master of the universe to being comfortable with his son operating the business. It took time for him to get financially comfortable that the son had the ability to take these assets that they built up over time and that he would be a good steward. It took him time for his wife to go from the bookkeeper to slowing down and not being the master of the universe herself. She, in many ways, was harder because she'd been all involved in the business, and for her to back off, in many ways, was harder than it was for him. But this gradual transition was just perfect for everybody. They'd financially put money aside over the years. They'd financially built a strong, successful business. They'd financially trained the son to develop and be successful. And Dad Dad trained himself to not have to be there all the time, not have to have the final word, and realized that he could retire. So I hope everybody's in the ideal category. I'm sure some of you are in the 1, 2, or 3 category. And I hope that you are able to learn from it. Again, my ideal focus on both ownership and management transition, training that younger generation to step up, ongoing and open discussions. We talk every single year. We did a 10% transfer of the ownership of the operating business every year. So we talked about it. We started early, we did gradually, so it wasn't intimidating for either. Parents were willing and able to step back, less so mom, and the child was willing to step up and was able to do so. So this is my ideal. This is the way, if you can make it happen, it's great and glorious and wonderful. It's not going to happen in every situation. Earnings are going to be a factor. Assets are going to be a factor. Number of children are going to be a factor. I've worked with businesses with as many as 12 children. That is a tough one. One child's easy, 2 is tougher, 3 gets tougher. But again, each family situation is different. But the financial considerations, people want to ignore it, but to me, it is the most important part. I hope this gives you kind of an overview of some of the key things. I hope these quick 4 case studies kind of give you the range of what are some of the options out there. Develop a team, like Mike had said last time, get a team to help you, but use a team and make a decision, move forward. If you do it over a longer period of time, you can change that plan over a period of time, look at the financials, adjust the strategy, make it happen. And I think you can. With that, I'm going to open it up fully to questions for any of the 3 of us.
So John, I'm going to kick off with a question for you towards a tax question.
Sure.
We've talked a bit about today, and we've talked definitely about last week. A common scenario these days is that in a gradual transfer, whether it's with somebody within the family or a non-family successor, key employee, or somebody you recruited, to do a gradual transfer by first taking the intermediate assets or the non-real estate assets and putting them into a limited liability company. And then work first on transitioning those intermediate assets through the LLC to the successor, while the LLC leases the real estate from the family who owned the older generation that owns it. And so the questions I want to ask, one of the things I get asked quite a bit is, so when I take my assets from my sole proprietorship or maybe a partnership and I transfer it into the LLC, are there tax implications for me transferring those assets into the LLC? And then secondarily, if they are transferring their equity to that successor through sweat equity, through gifting of shares in the LLC, as at least a portion of it, are there tax implications there versus if they sell those shares to the next generation?
Okay, excellent questions. If you're taking your sole proprietorship and you're putting those assets into an LLC, equipment, livestock, inventory, there's no tax on putting those assets in there. So you can contribute those with no tax effect at all. The next question was, is there going to be a tax if you gift those assets to the next generation? If it is truly a gift, there is no tax on that gift. So you can gift your ownership to the next generation. If the business has never been profitable and you've never made money and you borrowed to support your living, potentially there could be a tax implication. But again, almost in any business that's financially viable, you can give your ownership away with no tax implications. If you sell your shares, then there's likely going to be a tax on that. The level of that tax is going to depend on the type of assets that you sell, and there's something called the capital account that may determine how much of a gain that you may have on that.
So I'll have a follow up there, but from out in the audience there from Joan Falco, she asks, isn't there a gift tax?
Okay, there technically is a gift tax. However, the gift threshold currently in the U.S., you can give away annually $15,000 per person to as many people as you want with no gift tax consequences. There is also a lifetime gifting that you can do, and that threshold is currently $11.5 million. So up to $11 million you can give away federally with no gift tax consequence. If you give away more than $11.5 million, then there is a 40% gift tax. But for probably virtually everybody in the audience, you can give those assets away with no gift tax consequence. Most states also do not have a gift tax. Connecticut had one until a few years ago. I think that is now at $5 million. Massachusetts does not have one. I'm not familiar with Vermont if they do or not. Rhode Island does not either. And I'm not sure about some of the other states. One other point, I think that may be where you're leading to, Mike, is one of the reasons that we separate the operating business from the real estate business is that when parents make money in the operating business, any profit you make, you pay federal tax, you pay state tax, and you pay self-employment tax on that, the funds. So let's say you have a $50,000 profit on the farm. You're going to pay probably 20% federal tax, let's say, that's $10,000. You're going to pay 15% self-employment tax on that. That's going to be another $7,500. And you're also going to pay, let's say, 5% on state. So the state would be another $2,500. So you're going to pay a pretty significant dollars. That's almost 40%, $20,000 of the $50,000 in taxes on the profit that you make from the farm. One of the tricks in this succession planning is by transferring the ownership of the operating business that's generating the self-employment income to the next generation, is that you can also transfer that active income that you pay self-employment tax to the next generation. If you continue to own the real estate and collect rent from that operating business, from that LLC, rental income is only subject to federal and state tax. It's no longer going to be subject to self-employment tax. So that senior generation can now start collecting rent instead of self-employment income. That's going to reduce their tax bracket potentially from 40% down to 25%, or maybe even lower than that. So it's a way to transition your income to passive income, what they call passive income, instead of active income, and save you on your taxes. One other quick note, and I think you got a question there too, is that in an LLC, I love LLCs. because LLCs have two factors. They have the capital ownership of the LLC, who owns what percentage, and then they have the operating or profit and loss share of the business, who gets a share of the profit and loss of the business. So let's say mom and dad transfer over 20% of the ownership of the business. Mom and dad own 80%, the son or daughter owns 20%. But let's say mom and dad are scaling back in their work effort and the son or daughter have taken over. You could have mom and dad own 80%, but you could also have mom and dad only collecting 50% of the profit, whereas son or daughter owns only 20%, but they could be collecting 50% of the share of the profit or loss. So you can reward that next generation for more activity while retaining ownership in the near future. So it gives you an awful lot of flexibility in how you can transition the business.
If I could just go back to the gift tax just for just a few points of clarification. What I tell people is that if you exceed the $15,000 gift exemption, you end up still having to file a gift tax return, but there's not going to be any tax due.
That's exactly correct. Right,
Yeah.
Between $15,000 and $11 million, right? You have to file a return. You have to describe what you're transferring. If it's cash, you just say cash. If it's ownership share in an LLC, you will need an appraisal to support the value of that. And you can discount, do some discount for a minority transfer. So gift tax return is required. It'll cost you to get it prepared. It'll cost you for the appraisals, but there is no gift tax per se on that.
And then if you exceed the 15,000, well, if you want to give more than 15,000, but you're in a married couple, it's possible for, and I've seen this done where each, one farmer I worked with had two sons that were taking over. And so each adult each year was, they're all adults, each of the parents could gift 15,000 to each of their sons. So they were gifting 60,000 in equity between the two sons who were in the LLC in the next generation.
That is correct. You can use the spouses of your children, but again, that can present issues of son-in-laws, daughter-in-laws, and you want to give to them. Some cases it may be appropriate, some cases it may not. No, good, very good point.
Great. I'd like to open it up and see if there's anybody want to put in a question in the chat or turn on your microphone or your camera and come on and share questions. We have a few more minutes of John and Mike's expertise here, brains to pick.
Well, while we're waiting to see if anybody comes in, one of the other things that I think there are some clarification is when people put in, when they create a LLC, which again is a very common way of transferring now, it's a limited liability company, not necessarily a corporation, and that you have to elect how you want to file your taxes. And so people can choose, when there's multiple parties in the LLC, to choose to file their taxes as a partnership or as an S corporation, or very rarely a C corporation, very rarely for a farm, although I have seen it done, but generally an S corporation or a partnership. And I don't know if you want to comment on that, but generally you want to talk to your tax advisor about the best approach for your farm.
That is correct. I would say probably in 80% or 90% of the cases, I'm a fan of the LLC as a partnership versus an LLC as a corporation. And the reason for that is, as a partnership, you've got an awful lot of flexibility as far as allocation of profits and losses. If you have more than one partner, in an S corporation, you have to take out distributions, money from it in proportion to your ownership. In an LLC, you have a lot more flexibility where you can not necessarily take that money out in proportion to the ownership. For example, if you got mom and dad are owners in an LLC along with a child, and mom and dad don't need a whole heck of a lot of money because their living needs are smaller, or they've got some Social Security, other living needs, they could take out a smaller amount. Son or daughter could take out a larger amount because they may have family needs or a greater total. If you got an S corporation, you just can't do that. Both of them will give you some good liability protection. In an LLC, you do not need to take out a salary from the business. In fact, you can't take out a salary. If you're an S corporation, as the owner, you do need to take out a salary, which is fine in a profitable year. But if you got a lost year, you still have to take out a salary, even though the business lost money. The only time that an S corporation is, I think, good is if you got a very, very profitable business. You're able to transition some of the profit to a wage and distributions. Any profit you make in an LLC is subject to self-employment taxes. So other than very profitable businesses, almost always I'd like to see it as an LLC versus as an S corporation. Mike alluded, you can be a C corporation, but that's very rare.
I think you meant to say LLC filing as a partnership.
Oh, I'm sorry. Yes. Yeah.
So one of the things, and you just touched on this, where I see people thinking that they might want to have an S corporation, is because when they can collect a salary, then that becomes deductible as an expense against the business. But putting aside that profitability issue that you just mentioned, the thing that I point out to people is that in a partnership, an LLC filing as a partnership, they can also they can take an owner's draw, or they can take what's called a guaranteed payment, and that guaranteed payment is similar to a salary in that it is fully deductible as a business expense, and sometimes that's the much better option, and more typically it's the more better option for people.
Yeah. Only danger to that, Mike, is with this new qualified business income. Any money that's taken out as a guaranteed payment is deducted from the profit and is not subject to that 20% deduction. So you were exactly right until 2 years ago. Right now, if they take it as a guaranteed payment, they can wipe out their profit and they can wipe out the deduction. So there's certain times it's important. If you got a senior, junior generation, you may want to have some of the salary to balance them out. But if at all possible, we try to avoid the guaranteed payments right now, other than for health insurance. So it's the tax rules of the last couple of years have made life a little more challenging.
Yeah, this comes back to having your team and having an accountant that can look over your particular situation.
Could you just elaborate on that QBI deduction versus the guaranteed payment? I'm one of those fools that does his own taxes.
All right, let's say you make $100,000 profit in the business. And it's a 50-50 business. If you take out $100,000 as distributions, you've got a profit in the business of $100,000. QBI goes onto your personal return, and you can get up to a 20% deduction against that. So let's say each person has $50,000 as their share of the profit. They can take a $10,000 QBI deduction against their taxes. They now only have $40,000 as taxable income. Let's say instead they each take a $40,000 guaranteed payment. Now you've got a $100,000 profit. You take off $40,000 each as guaranteed payments, or you've taken off $80,000 total. Farm now has only a $20,000 profit after guaranteed payments. When you go to your personal return, you've got a $40,000 guarantee, but you've only got a $10,000 share of the profit from the business. You can only take that 20% on the 10 grand, which is only a $2,000 QBI deduction instead of a $10,000 QBI deduction. So you're
okay. That's helpful.
Yeah.
But 179. I mean, switching just for a moment to something like a 179, and if you take that, you're reducing your profitability, so you're reducing your QBI again.
Yes.
So is that something you should consider in your depreciation or not? Or should you always take that?
You should always take into account, because when you do take that 179, historically it reduced it down by that full amount. Now it reduces it by that amount for taxable income, self-employment income, but it also reduces by 20% that QBI deduction. So it doesn't have full consequences, but it makes that section 179 basically 20% less valuable.
Mm-hmm. And that QBI comes up under Z, I guess, in the K1 or whatever on the LLC.
Yeah, it comes out at the bottom, and
yeah.
again, it's limited. If your personal tax returns are not making any money, that QBI is also limited by your taxable income. So it's a messy calculation.
Yeah, got it.
And Tim, I knew I could count on you to ask a tax question. I've known Tim for over a decade now, and he can spit out all the letters and numbers as well. So his next career, Tim, is an accountant.
Well, I had two other things, if you don't mind. I'm a little.
Don't bury it too much in the weeds, and everybody starts disappearing on us.
No, these are. See, I consider myself Mike's greatest failure.
No.
I've been working.
Janet partner in there who's half owner in the business and succeeding, and
my wife and I have been working with Mike to transition for 10 years now, and so I guess my message to everyone out there is that it is a long process, and when you've been doing this for 40 years, a little over 40 now. What you think you might want to do 5 years ago may change over that period of time. So as of about a year ago, I thought I would be transitioning out and retiring. I'm 69, will be 70 this year. And partly because of COVID, partly because of the person who was coming in, and partly because of my partner, and partly just because mostly because I just love farming, I decided I wasn't ready to give it up. So I haven't, and I'm so happy that for the first time in 10 years, I'm not thinking about retiring, and I'm almost 70. And so that may not fit into the appropriate age bracket, but what I will say is I know some farmers that I've learned a lot from that are considerably older than me and who are still pretty happy doing what they're doing. We have made some progress, Mike knows. So I'm 50-50 with someone who's worked for me for my wife and I since they were 14, and now they're in their early to mid 30s. And we're 50-50 partners as it relates to the business, which is a quite successful business. And then my wife and I still own the farm and land and buildings. And so I think the next step will be for me to step back out of the business aspect, and then we'll lease the farm for a period of time. One couple of things we did that I still wanted to go back to. One, we've now know where we've moved out of the farmhouse. I sent Mike some pictures just recently, and we're living 1,000 feet from the farm on a piece of land we had overlooking the farm. So that part of the puzzle's taken care of, and it's all on one floor.
Built a new house that he's contacting us, zooming in from.
Yeah.
Just moved
and
in.
So that's successful. But I do want to go back to the easement situation again, because one of the things is when we sold to the Vermont Land Trust, it was very important for us to have this farm continue. And it is not exactly in the village center, but it's right in Post Mills. It's part of the village. And once had a proposal for 56 houses on this farm back in the 80s. So what we sold the Vermont Land Trust was also an option to purchase at ag value. So when you say it can't be used but once, I think that's a little misleading in the sense that the next generation is going to be able to have an appraisal done of this farm, and they'll be able to buy it at agricultural value and not at development value. And I think that's an important distinction, because we got a significant payment through the Housing Conservation Fund and private, fundraising and the federal government. And so when we sell that, it will go for less money, significantly less money than what we would have if you were selling development rights again.
Right. Well, I think that the key there is then that next generation has to take the money that they're saving, and then they are sorry, dog, had to be a dog. All right. So they're take that money that they're saving and actually putting some of it towards some alternative retirement. Right.
Absolutely.
I think that's the difference.
I worked with one farm operation where Dad was incredibly important to him to have that farm legacy. The 35 Jersey cows. He had an ice cream stand, lost money every year, but he wanted it to go to the next generation. So what he did, he put that farm into a dynasty trust, he also put in 2 rental properties, which consistently generated a profit. He said, I want that farm to continue, whether it makes money or loses money. I'm willing to put these properties in there to supplement the cash flow. So that was a way for him to, as a solution, to continue the legacy, but also not burden the next generation with the potential of having to subsidize it. So kind of a good solution.
Mhm.
You know, I just want to put in one other plug here is that, you know, when Tim brought on Phil as a partner, you know, the business was already a very profitable vegetable operation. But I think, Phil, Tim, you would agree that Phil it helped with the continued improvement of the profitability of the business, including some of the decisions you made, like to buy the farm stand from Killdeer Farm, which has been a good profit center for the business. And I remember you telling me you wouldn't have gone forward and made that purchase if it wasn't that Phil was a partner, and that's what Phil saw as part of the future for the business. And
That's absolutely true.
Yeah.
Yeah, no, that's absolutely true. Yeah. Yeah, no, we were getting ready to roll it back to a nice little retirement farm here, you know, with our little trade around Lake Fairley and that kind of thing. But when he stepped up to that, I said, sure, let's go for it, but you're going to be a partner then. So that's where we are now. Yeah.
Tim, I don't know if you have other questions, but we have another one coming through in the chat too. Do you want to ask anything further?
Oh, I'm good. Thank you.
Okay. Linda, if you want to unmute and join, you can, or I'll go ahead and throw it out there to you, Mike and John. Would you use OPAV instead of a conservation easement, or can you have both?
So the OPAV is the option to purchase at ag value is a component of a conservation easement. It doesn't really stand alone. Part of it is it needs to be enforceable. You know, so right now it's an option in limited area. You know, we had originally people from 20 states signing up for this. So in most of the country, it's not available. It's Vermont, Massachusetts, a limited amount in New Hampshire right now. Maine is starting to use it. There's places in the Hudson Valley of New York where they're starting to use it as well. New Jersey is toyed with it. I'm not sure outside of the Northeast how readily that tool has become available, but the enforcement of it becomes a part of the stewardship of enforcing a conservation easement.
Great, thank you. We're getting a lot of thank yous in the chat. I want to take a moment to thank our funders who made it possible for this webinar series to be available this year and to be available at no cost. So that's the Vermont Housing and Conservation Board and the U.S. Department of Agriculture through Farmer and Rancher Development Program grant. And I want to thank all of you for joining us, because this is a really important topic, and to take time out of a sunny day to dive into financials is a big commitment. So thanks for doing that. I'm going to put 2 links in the chat. One is a link to our evaluation form. We'd love to hear more feedback from you all about how this workshop today worked for you and what else you would like to hear. And then also I'm going to put in a link if you are interested in getting one-on-one assistance in New England. You can fill out a link on the Land for Good website to get started with one of our field agents for that support. We will be following up, as I mentioned, with the recording and the resources from today. And then also next week, you can join us back, same place, same time, 11 to 1. We'll have attorney Paul Dillon with us also to talk about the legal considerations of a farm transfer succession planning. So that will definitely be a lot of great information to wrap up our series. And feel free to reach out to myself or John or Mike and stay connected with us on social media or our website for lots of information. And that's what we have for you all today. Enjoy the sun. Thank you very much, John and Mike, for all of your information. It makes 2 hours, even talking about financials, go by. So. Any last words, John or Mike?
No, just thank everybody and start planning.
Yep. See you next week.
Okay. Thank you all. Have a great day.